Friends, please watch. What's unfolding before our eyes is a hysterical showdown of capital. On one side, there are AI concept stocks. Like bullfighting bulls on steroids, they've soared to the skies at a breathtaking pace over the past few months. Every leap, every limit up is accompanied by the frenzied screams of retail investors and the determination of gamblers to stake their fortunes. On social media, everyone is buzzing about computing power and chips, as if missing out on AI means missing out on the wealth train of the century. But please calm down and look at those sky-high stock prices. They're already trembling. Amidst the violent fluctuations and relentless sell-offs, investors who have been holding on to their positions are now experiencing a soul-wrenching pain. That's not investment, that's sacrifice. They've sacrificed their hard-earned money to this fleeting bubble. But amidst the AI clamor, another Forza-old antique that has been dormant for over a decade, once forgotten by everyone, is quietly erupting. Yes, I'm talking about nuclear power. This energy giant, once labeled a sunset industry and a fading hero, has become Wall Street's latest aphrodisiac. From uranium mining companies to cutting-edge reactor technology firms, any mention of the word nuclear sends its stock price soaring like a rocket. Everyone dreams of the overnight riches nuclear power will bring, dreaming of becoming one of the lucky winners of this resurgence. But please, hold your eager hands, because I've discovered an extremely unusual and disturbing phenomenon. Just as we, the small fry, are enjoying a surge of adrenaline from the gains in upstream mining stocks, the world's top capital giants, those sovereign wealth funds holding trillions of dollars, those legendary investors known as Wall Street's living fossils, are chanting "Long live AI." But their capital flow reports betray their true intentions like traders. They haven't rushed into uranium stocks, which have seen their value rise tenfold, nor have they grabbed those high-odds gambling chips. Instead, they're quietly, like ghosts, buying up large amounts of what we consider to be unremarkable, even somewhat unwieldy, utility companies. What does this mean? Does this even make sense? It's like everyone heard gold had been discovered in California, so everyone rushed to the mining area like crazy, shovels and pans in hand. What happened? The most experienced and savvy people, on their way to the gold mine, started selling water and shovels, building roads, and opening hotels. What shocking secrets lie behind this? What underlying logic did they see that most of us are completely oblivious to? Why, in the promising nuclear power sector, has the smartest money chosen this seemingly timid and conservative approach? Today, let's debunk the myth of nuclear power's exorbitant profits. When I argued that the end of AI lies in electricity and that energy infrastructure will be the next NVIDIA, many people might have laughed at me, saying, "You're outdated. Now is the era of computing power." The result? From Constellation Energy, CEG, to GE Vernova, GEV. These power infrastructure giants have experienced independent, strong performances over the past few months that rival those of tech stocks. Today, we are talking about nuclear power and its core variables, which 99% of people misunderstand. Please believe me, this is a harsh truth. You might think that power generation is the most profitable part of the nuclear power industry. Wrong. Dead wrong. Please engrave this sentence of mine in your investment dictionary. In a deterministic major trend, the most lucrative link is never the production link. The true profits of nuclear power lie in those links that can transform trends into stable, continuous, and even monopolistic cash flows. Power generation is merely the raw material for this feast. The real links that transform electricity into a continuous spring-like cash cow are the subsequent transactions, transportation, and terminal services. This is the ultimate battlefield in this game. The top titans on Wall Street aren't gambling. They're searching for a money-printing press. They gave up on high-odds uranium mines precisely because they pursued certainty, the kind of monopoly profits that promise guaranteed returns regardless of market conditions. To help you fully understand the logic of cash flow first, I've carefully selected for highly representative power oligarchs from the stock market. They're like four crucial puzzle pieces. When put together, they form a complete map of the downstream nuclear power industry's wealth. First, you must recognize the absolute king of power generation, Constellation Energy, CEG. You can think of it as a superlandlord with a vast portfolio of prime real estate in prime locations. Its business model is simple, almost brutal. It owns the largest nuclear power plant fleet in the United States, providing the most stable, reliable, and uninterrupted clean electricity 24/7. How stable is it? Its unit operating reliability rate is a staggering 98.8%, and its capacity utilization rate is an astonishing 94.8%. Stability is its most formidable moat, but most crucially, this superlandlord has found the world's most high-quality tenants, most willing to pay high prices for long-term leases. AI giants like Microsoft and Meta ***. CEG's power purchase agreement with Microsoft is a long-term agreement, lasting 10 or even 20 years. This means that for the next 10 to 20 years, no matter how the economic cycle fluctuates, No matter how drastically electricity prices fluctuate, there will be people lining up to pay cash for every kilowatt-hour of electricity CEG generates. Their logic is to secure orders first, then start the power generation. They restarted 3 Mile Island 1 precisely because Microsoft's order was already signed in black and white. CEG isn't a speculator betting on electricity price fluctuations. It's a ruthless cash flow machine focused on certainty. If CEG is a prudent landlord, then this market also houses the most aggressive and speculative middleman, NRG Energy. NRG, you can think of NRG as a giant electricity supermarket owner. Its core strategy is 2 words: price differential. Buy low, sell high. It buys electricity at a lower price from the wholesale electricity market and then sells it at a higher price through its retail network, which covers nearly 5.9 million households and numerous businesses. The greatest feature of this model is its high elasticity. If electricity prices rise, NRG's profits will instantly increase. Conversely, if wholesale electricity prices rise faster than retail prices, its profits will shrink like a sponge being squeezed mercilessly. Thus, NRG is a complete leveraged player. It plays on the heartbeat of market fluctuations. It even spent $12 billion to acquire natural gas power plants just to increase its supply of low-cost supply. Investing in NRG is like riding the back of market cycles. It is suitable only for investors willing to take high risks in the hope of achieving outsized returns. Having discussed power generation and electricity sales, let's look at a more fundamental, behind-the-scenes engineering giant, GE Vernova. If electricity is the flow of blood, then GEV is the infrastructure freak responsible for building its blood vessels and heart. Its business is to provide a complete suite of electric highway solutions, from gas turbines and nuclear power units to transformers and high-voltage, direct current transmission systems. Why do I say GEV is one of the most promising growth stocks right now? Because the power grid in the United States and around the world is aging. These outdated grids simply cannot handle the monstrous loads posed by these power-hungry AI data centers and electric vehicle charging stations. A complete upgrade and expansion of the power grid is one of the most certain grand narratives of the next decade. And GEV is the monopoly king in this field. How many orders does it have? Over $119 billion. This means it has a full schedule for the next several years. Its business model is order-driven and very stable. Investing in GEV means investing in the grand blueprint for U.S. energy modernization. It's a company suitable for strategists who believe in long-term trends and pursue growth potential. Finally, there's Southern Company SO, the king of the last mile and the one with the most perfect cash flow model. SO's business model integrates power generation, transmission and distribution, and end-user sales. Within its service area, it's the sole king. You can think of it as a highway toll booth with a regional monopoly. As long as you live in this area, whether you're an ordinary household or a power-hungry data center, you must pay its electricity bill. Its customer loyalty is so high that churn is almost zero. This results in extremely stable and predictable cash flow. Furthermore, SO's growth driver is clear. Electricity consumption from its data centers has increased by 13% year. These AI giants are willing to pay a high price for this. So is like a toll collector guarding a gold mine. It's a classic defensive asset, stable growth in a good economy and steady revenue even in a bad one, while maintaining a consistent dividend policy year-round. It's suitable for income-seeking investors who seek ultimate stability and a guaranteed annual cash dividend. Well, putting these 4 companies together, a wealth map of the downstream nuclear power industry has become very clear. But remember, there's no such thing as a stock that keeps rising without falling. These 4 companies are all shrouded in the specter of risk. CEG, it could face unexpected policy and security. RISKS NRG, the risk is the highest. It's a gambler. A mismatch between cost and selling price could wipe out profits in an instant. GEV, the $119 billion order potentially carries significant execution risk. So, the biggest enemy is interest rates. A cycle of rate hikes will reduce its appeal. Therefore, there are no perfect investments, only the ones that best suit you. The key is to clearly understand what you're buying, how you're earning, and the risks you're willing to take. Faced with such a complex yet opportunity-filled market, what should ordinary investors do? Today, I'll provide you with a simple, actionable, nuclear energy offensive and defensive strategy. You just need to focus on 3 things: a steady base, 40% to 50%. Rent-to-import stocks as your foundation, percent to 50% of your portfolio to cash cow, companies like CEG or SO. They are your anchor, allowing you to sleep soundly even during market turmoil. Growth supplement, 30% to 40%. Infrastructure stocks as your tower, use 30% to 40% of your portfolio to invest in growth engines like GEV. You're investing in the most certain, major trends over the next 5 to 10 years. Flexibility, no more than 10%. Trading stocks as your cavalry, no more than 10% of your portfolio to leveraged players like NRG. Think of it as a lottery ticket, as your light cavalry in your pursuit of excess returns. This strategy allows you to enjoy the long-term dividends of the nuclear power resurgence while effectively controlling drawdown risk. The world of investing is filled with noise and temptation, but true wisdom often lies hidden behind those anomalies. Understanding the essence of business models and finding a money-printing machine that can consistently generate cash flow is the only way to navigate cycles and achieve wealth growth. So, among the 4 sectors of power generation, trading, power grids, and end-user services, which do you think holds the greatest potential for explosive growth over the next decade? Feel free to share your thoughts and insights in the comments section, and let's discuss.